Hello everyone, welcome to another episode of CK Breakdown. So this episode I decided to make it in English is because we're doing something a little bit more technical, and as you may know, my Thai is terrible. So I really want to make sure that the content that I'm talking about here is some very, very technical financial concept. I want to make sure that I portray in a very accurate manner. So I thought doing this episode in English will be more clear for everyone. Hopefully the subtitle, the translation can do me justice. So today I want to talk a little bit about the concept of stock buyback. So I think with the current economic climate, you hear the term stock buyback quite often. And whether if it's politicians saying that, oh, stock buybacks prop up stock price or whatever it is. So I think it's an important concept that we all need to study and to understand what is it? What is stock buybacks and why do companies do them? So to start it off is when you have an IPO meaning initial public offering, that means that you're raising capital from the public market. So by definition, you're issuing more shares of your company to the market by diluting your shares in order to raise money. Amazon is a very good example. Amazon have been, raising money from the stock market consistently every year to raise money for their business because their business needs scalability, needs a lot of capex. They need to invest in warehouse, airplanes, cars, and so on, and headcounts in order to meet economic of scale. So Amazon is a very good example of how you can raise your share by diluting your own shares within the company. So when you do stock buybacks, that by definition is the opposite of stock issuance. So when you do stock issuance, you are diluting your own shares. But when you do stock buybacks, it's the opposite of dilution. So when you do stock buyback, that means that the number of outstanding shares will be lower in the stock market. So what does that happen? That means that because by reducing the number of outstanding shares in the public market, that will automatically pump up your EPS, earning per shares. Therefore, the stock price will also go up. So, but when do we do stock buybacks? And what are the choices? When do we do stock buybacks and when do we do dividends? So these are the concepts that we'll discuss today. So a company that's very, very interesting will be AutoZone. So AutoZone is basically a car part, automobile, ICE engine focused kind of company. Very, very slow growth. So over the year, they grew less than 10% a year in terms of revenue. The top line has been very, very low growth, but the profit has been strong every single year to generate enough free cash flow to buy back stocks. And the stock price, if you look at the past 10 years, the stock price grew 500%. It's incredible. How can a company that basically have no growth, very, very slow growth in the top line, how can that company's stock price grew 500% in the past 10 years, which is a lot more than S&P 500, by the way. So they beat the market by the long shot, and they were doing it by the simple concept of stock buyback. And this concept does not work for every company. AutoZone is able to do it consistently because they have a very low PE ratio. They have a PE ratio of less than 20. Well, what is PE ratio? Price to earning ratio, meaning that the price is the stock price that is in the market, and earning, the E, the denominator, represent the actual earning, income, profit of the company. So meaning that this company is trading less than 20x of the earning in the actual stock market. So that makes it a very, very cheap company. Usually a lot of tech companies are trading like 80, 100, depends on the industry. But for this company, they are able to do it because they have a fairly, very, very low PE ratio. When you have a low PE ratio, that means that your stock is cheap. So buyback makes a lot more sense than dividends. On the other hand, when you have a high PE ratio, dividends might be making more sense. For example, Google. Google is also another company that does stock buybacks consistently. But their strategy of stock buyback has not been as effective as AutoZone. That's because they have a fairly high PE ratio. When you have a high PE ratio, that by definition, that means that your stock is quite expensive in the market. And Google is also a company that consistently give out stock-based compensation. And when you do stock-based compensation, what does that actually happen is, a lot of companies do stock-based compensation to prop up profit. For example, instead of paying employee salary, they pay them in stock-based compensation, which is a cashless transaction. That means that by giving them stock-based compensation, effectively they're reducing their expense in their HR department. So by definition, their profit is higher than what it actually really is. So as a smart investor, hopefully you all are, in order to calculate the true profit of a company, we will need to look at the net income and subtract by the net value of the stock-based compensation of that particular quarter or that particular year. So that's what we usually do. So Google, they give up a lot of stock-based compensation to prop up their profit, which makes, when those options are exercised, the buyback is extremely hard because the PE ratio will be extremely high as well, which makes their strategy a lot less effective than AutoZone. So basically the lesson today is that if you are a company in an industry that is not very fancy, very tech savvy, have a very high PE ratio, for example, not like Tesla, which is basically a car company but priced as a tech company. If you're a company that is priced at the market, or if you're thinking about investing in a company that is priced in the market at a fairly low PE ratio compared to their peers, and you have a strong free cash flow every year, you can generate quite a bit of return, a substantial return through the concept of stock buybacks. But if you are a company that has a fairly high PE ratio, worse is that you don't have a lot of free cash flow. But if you have a lot of free cash flow, but your PE ratio is also fairly high, then giving out dividends would be a more attractive option than stock buybacks, because that will be cheaper by definition. So hopefully you guys understand the concept of stock buybacks a little bit more. And as always, thank you for listening.